We've just had the largest drawdown in the history of that strategy. This is unprecedented.
Hey guys, welcome back to Library of Wealth. Today we have macro investor and crypto bull Raoul Pal outlining why the market could be the last opportunity for investors to generate gains during this period of rising inflation and crashing stocks. Pal takes us through how to navigate the crypto and stock market during this volatile cycle, his investment thesis, and his financial outlook for the coming months. Now, even though we're in a recessionary climate, Raoul says that we haven't seen the worst of it. He believes that the current trajectory we're seeing now is only a precursor for what's to come. The Federal Reserve uses money printing to stimulate the economy, but that growth is short-lived as the inflation rate gets higher and higher. You won't see the effects right away, but it's a time of investor panic when they see red across the board in the market. Let's get into the interview with Raoul Pal as he lets us know what to expect in the crypto, stock, and bond markets up until the end of the year. Don't forget to like and subscribe if you enjoy the content we do here on this channel. Let's get right into the video.
And it's a game of musical chairs where somebody gets rug pulled and somebody falls to the floor because there's not enough chairs to go around. We've seen numerous countries go into default or renegotiate with the IMF and the World Bank and others. That's the shortage of dollars. The shortage of dollars is what puts the European banking system under pressure. The shortage of dollars kind of knocks through for the global market. Now, there's another issue going on right now is the US, its trade deficit. If you think of a trade deficit, it's the US buying goods abroad. That's spending dollars elsewhere, so the rest of the world gets those dollars and they get to recycle them into treasury bonds or do other stuff with them, have borrowings against them. When the US runs a smaller deficit, there's less dollars in the global system. So that makes another problem. So you've got liquidity being sucked out and you've got the trade deficit, meaning less dollars are going in the system. Yet in a slowing economy, everyone needs to pay the interest on their debts, so demand rises. That's the mess we're in. Foreign central banks end up having to sell their treasuries to either support their own currency or because they kind of need other things to be able to do with the dollars that they hold. That becomes an issue, or they want to receive the dollars to pay off the interest on their debts. That becomes an issue because it's driving higher interest rates. Right now, the interest rate market has no buyers. There's no buyers of bonds. I've never seen this before.
Because wages haven't gone up in the last 50 to 60 years, but inflation and prices have, millennials can't get ahead. Pal explains how the devaluation of currency has not only led to globalization, but the Fed's protection of money didn't lead to an increase in wealth. We've never had inflation of this kind without recessionary measures. It's up to the Fed to bring it under control and navigate the economic, global, and geopolitical situations effectively.
And the pension system. And the pension system has just taken the biggest loss ever in the 60-40 portfolio. That's the portfolio of equities and bonds, 60% equities, 40% bonds. That was the safest investment style of all, and the entire pensions industry worldwide uses it as its benchmark. We've just had the largest drawdown in the history of that strategy. This is unprecedented. I know everybody looks at the equity market and says, well, the equity market's only down 30% if it's the NASDAQ or 20% if it's the S&P. They're missing the fact that pension portfolio has been obliterated. So if you think what just happened in the UK, there was some leverage to cover their liabilities. And with this drawdown, they blew up the pension system and the Bank of England had to come and step in. So that's the dollar problem. The dollar problem is great for the US right now because it means that anything you buy from abroad, particularly the US buys an enormous amounts of finished goods from China, Germany or Europe, Japan, South Korea, Taiwan. Those are the big industrial nations that export goods. All of their currencies are down between 15 and 30% against the US dollar. The pain trade, I think, is to sucker everybody in thinking there's a great glory collapse to come. The I told you so moment in earnings are going to get revised lower. Well, all I do know is people are record negative sentiment. They're more negative than I've ever seen ever in any history. I wrote a big article in Global Macro Investor, my institutional research service about this. They're super negatives. People are super hedged. Put volumes have been incredibly high. So I think the path of pain is to go lower, suck more people into short, and then rip higher. And it would rip higher because bond yields start to fall as they start finally recoupling for the business cycle. bond yields have massively decoupled from the ISM survey. That's a relationship that's gone back 50, 60 years, including the last inflation episode. It's decoupled from inflation break-evens. It's decoupled from economic growth by any measure. The bond market to me is broken. It is now a function of illiquidity because nobody's involved in the market and there's only sellers. And I think it's going to cause some tremendous problems. And that eventually is going to create the answer. And the answer to everything is always more cowbell. The UK showed it, more cowbell, print more money, get us out of this problem. When people say they'll keep hiking until it breaks, well, when it breaks, more cowbell. You know, it's all, the whole system is now set up for one cry, which is more cowbell, turn the taps back on. It's a sad state of affairs, but that's how it is. So October feels like it's a volatile month. It feels like we've got downside, sharp downside to come. Then we get the reversals. Maybe we've broken something bigger. Clearly, we're in inflation right now. You have to be a blind monkey not to realize that. I actually didn't think it would go this high, but I also didn't actually have in my bingo card Russia invading Ukraine. But we get these things wrong. That's the part of markets. My view is that this inflation turns to deflation. I know there's a massive analysis of structural inflation driven by supply issues in the oil markets. We could see that today, this fight that goes on between supply and demand. I know a lot of people think that much of this is stickier. I know a lot of people also just emotionally want to punish the Fed for quantitative easing because they want to prove that it has inflation. Those tend to be the gold types. We told you so. Angry men shaking fist at the sky on the internet. My view is that when you have a year-on-year rate of change of interest rates like this, when you have just the mathematical effects of these numbers for next year, it's bloody hard to have positive inflation. And my guess is it goes negative. And my guess is a recession causes more demand destruction.
Powell says that people in the market believe that everything is cyclical, meaning that everything in the system defaults to what came before. He says that we're now in an exponential trend, which no one is prepared for or even knows about. People need to understand that everything in the market in an exponential trend environment becomes better. Powell believes that it's essential for everyone to become proficient in what technology investors have mastered long ago. People must be comfortable and skilled at buying into sell-offs. Powell notes that if everything in the economy immediately becomes solved, it will still be too late for many people. This is because they lack the conviction to seize an amazing once-in-a-lifetime opportunity that would have yielded a massive payoff. What do you guys think about Raoul Pal's current market strategy? Let us know in the comments below. Thanks so much for watching. Don't forget to like and subscribe. This is Library of Wealth. We'll see you in the next video.